Most swing traders will use the weekly and monthly time frame for their higher time frame bias, but there's a missing piece, the 2-week time frame. So on the weekly time frame, sometimes you can just be getting into too many trades and actually getting stopped out before moves play out. On the monthly, it isn't always obvious where price is going to react from, even if your bias is 100% correct. So the 2-week time frame can give you a lot more context to take high probability trades like this 3R that played out on Euro NZD. So we're going to look at how to use the 2-week time frame, especially in conjunction with the monthly time frame, to get into high probability swing trades. So let's take a look at what's going on. So I'm using 12-hour price action, and I want to play trades on, like I say, the 2-weekly and monthly time frame. Sometimes I'll use the weekly, but I'm not going to cover that here. So first things first, I'm going to overlay onto my 12-hour price action the monthly chart. And what we see right here is that in the previous candle to the trade that I just displayed, we had a bullish close. So looking at the monthly time frame for this entire range of price action, let's mark that in green, we had a bullish candle, and this closed above its previous candle. So from a monthly standpoint, we're not sweeping this high, so we would think that based on this close, we're looking at higher prices, which does play out. But where is price going to react from? Is it going to retrace lower? Is it going to come off the body? Is it just going to go straight up? We need additional context. So what we can do, actually I'll just leave that there, is overlay the 2-week time frame. And then what we get is a lot more clarity and context. So the first thing we see is that we had a candle that closed above its previous candle. So we had this candle here, price accelerated very aggressively and closed at this level here. So we have also a bullish 2-week candle, but we're in a downtrend. So what is price likely to do? Well, it seems that it is seeking liquidity. So we can just mark price action to see when we see a shift that makes sense. And where is that shift taking place from? So price is selling off. We get what looks like potential bullish price action. However, from a 2-week standpoint, we're not sweeping any liquidity. And what we're actually doing is just testing these swing points. Price then sells off aggressively until we raid or trade into the external range liquidity at the low of this 2-weekly candle. At that point, we get aggressive price action. So now, instead of seeing a shift here, where we're not sweeping any liquidity, we are now raiding or sweeping a 2-week candle's low. So if I take away this, you can see this very clearly, we have a potential 2-week CRT about to play out, whereby price is going to sweep the external range liquidity at the low of this 2-week candle, shift bullish, and then the most logical place for price to target is the high of the candle that has been manipulated. And this, if I take this now away, aligns with the previous monthly high. So this new monthly candle is creating its bottom wick and is about to push higher because we got a bullish close in this candle. So we can now combine that thinking to take two options. Regardless of where you're going to target, you want to find a place to enter. So actually, before I do that, let me show you the internal range liquidity that is built in this price leg. So we have the shift, we have a true market structure shift right here, whereby we had a swing point traded through, and now we have a new 12-hour order block. So this sits at the base of this price leg. See the last sell to buy. And then we also have the formation of a fair value gap. So this is the imbalance between candle 1 and candle 3. It's an inefficiency in price. So what we can then do is trade from the fair value gap. We can cover the swing point at the base of the order block right here, and then we can take a trade to the 2-week high. So that plays out for a perfect 2R, which is a great trade. However, if we now take away the 2-week candle and overlay the monthly candle, what we see is that we're printing bullish candles, so we might want to go higher. So you can hold this for even higher targets. So you might want to take, say, a 3R, and that actually plays out quite easily. And then from there, you can basically trail your stop below the highs. If you were to below the lows, sorry, and if you were to do that, you would eventually get a 3.5R trade before retracement comes into the market. So what we're doing is combining monthly thinking with the execution on 2-week timeframes to get into high probability trades that play out for over 3R multiples. So let's look at some theory before going over another example. So the 2-week time frame is the missing piece. It's your intermediate time frame that combines or acts as an intermediary between the monthly and your price action, and even the weekly candle to an extent. So most traders either trade too high, they're just using the monthly and they're missing opportunities, or they're too low, they're on the daily, the 4-hour, maybe the weekly candle, they're getting chopped up by noise. So the 2-weekly range gives you, in swing trading, better context and high probability targets, especially when you use it in conjunction with the monthly candle. Why does it matter? Because we want higher time frame context and targets to get into high probability trades. So let's look at an example on USD CAD. So we're going to join price action right here. We're still on the 12-hour time frame, and we've got our 2-week candles overlaid onto the time frame. And what we're seeing is essentially bullish price action, whereby lows are being respected and highs are being traded through. And we create a 2-week bullish candle. Price then trades back into the internal range liquidity in this price leg and moves higher. So we break above the swing point. Price trades back into internal range liquidity, tries to move higher. Then we get a shift bearish. So this is our first sign that there might be bearish intention coming into the market. And where are we actually reacting from? A previous 2-week candle's high. So there's external range liquidity right here that we're raiding. Price then shifts bullish. So this is enticing new longs into the market, but that isn't actually what's happening. Price is sweeping this high. This is just looking to build more liquidity for big money in the market to sell into, which happens very aggressively. We get again another market structure shift. So we can now look at what's going on in this price leg, because what we're seeing is that the 2-week candle is about to close. We've swept this high. So the next logical path for price is potentially to the low of the previous 2-week candle. And what we can do is then look at what's going on in this price leg. So this would give you an entry right here, or you can wait for that more aggressive shift and then seek your entry. And here we have the last buy to sell candle. So this represents our 12-hour order block. We also have this swing point here. So this is our swing high for this price leg. We also have a fair value gap between candle 1, down close candle, and candle 3, an inefficiency or an imbalance in price. So we can look to take a trade on this candle here from the fair value gap, covering the order block and the swing point, and we wait then for price to trade to our target. And what ends up happening is that the candle closes, the 2-week candle closes at this point here. Price does retrace, but it respects this internal range liquidity and then dumps aggressively to this low. So you get basically a 3R trade play out by just understanding the 2-week time frame. You would never have got this trade if you were just looking at the monthly time frame. Second thing to then check is, where are we targeting from a monthly standpoint? Well, at this point, unlike the last trade where we saw it made sense for price to continue higher, it doesn't yet make sense for price to continue lower. So I would use that low as my exit point on this trade. I would get out of the trade immediately once we hit that level. And that's exactly what happens. We then get another shift and price moves higher. So that's how to make 2-week time frame play in your favor. If you have monthly on side, you can push for higher targets. If you don't, just take your target as the CRT completion of that 2-week CRT, whereby you get range or accumulation, manipulation, and then dump to the low. So how do you apply this? Identify your 2-week candle range always in conjunction with weekly and monthly candles. Wait for liquidations of 2-week highs or lows, and then confirm 2-week candle closes inside previous ranges, or at least look for market structure shifts or order flow shifts. Towards the end of the candle, if it's the manipulation candle, then execute using your 12-hour price action, targeting the opposing extreme of the 2-week candle that you're manipulating. So you're looking for that accumulation, manipulation, distribution pattern in conjunction with the monthly time frame. My model is that I track and analyze 32 Forex pairs, including gold, silver, and Bitcoin. I track 12-hour price action in conjunction with weekly, 2-weekly, and monthly candles. I just wait and execute. Once you get good at this, you can do it in 10 to 15 minutes a day and then just get on with your day. So if you want to get into swing trading, you want to learn more about how to take high probability swing trades, subscribe to the channel and I'll see you on the next one.